Hi, everybody. This is Luke Stein, and I'm going to do this live stream with my students for Babson Fin 6200, which is a financial data analysis and practice class for Masters of Science in Finance students. And folks finished up their final exam last week, but I promised that I would try to take a crack at it as well. So just a few things. One is I am teaching coding, but I'm not really a Python expert, and I am going to try to answer all these questions, but it's not production code for sure. It's going to be a first draft, so if this were me turning in an exam for a class, I would definitely clean a bunch of stuff up and check more. I'm going to focus on trying to solve questions in ways that I think might have been realistic for my students to make progress with, which sometimes is not kind of the most efficient way, but I'm going to try to focus on the tools that we covered in class. I emphasize in the class and on the exam the importance of interpreting results and stuff, but I'm just going to focus mainly on doing the code. And of course, I have seen the questions before because I wrote the questions, and I've done some coding against them. Students in the class, so my expectation was that you already had familiarized yourself with a bunch of the material that was in these resources. I'm also posting this because I do want to be able to share this with future FDAP students. And so by the end of the class, hopefully, these are some of the resources that you will have used, including Ellen Downey's book on Python coding generally, Jake Vanderplas's 2 books on sort of data science focused coding, Wes McKinney, the great resource there, and then Arthur Terrell and Kevin Shepard have these great resources or books that we've used as well. So let me see. So here I am. This is the exam file as distributed. Hi, Stephen. Good to see you. I think we can even get you up on screen if you'd like. So this is the exam file as distributed. Like I said, obviously I've seen this before. And I'm going to post a link to these questions for anybody who wants to see them. But we start out by asking in a single cell to import all of the packages that we're likely to use. So what I'm going to do is I'm actually not going to put any imports in here now. And then as I use things in the code, I'll just come back up here and add those imports as necessary. Okay, so part 1 is going to be imports. Part 2. So write a Python function called integrity check that takes 2 arguments, one called name with no default, one called agree that defaults to false. So I'm going to start there by defining a function called integrity check. And it's going to take 2 arguments. One is going to be called name and take no default. The other one is going to be called agree, and it's going to default to false as requested. And what's that function going to do? Well, if agree is true, I obviously don't need to check equality with true, because if agree is true, it's going to be true. What do I want to do? So I want to print out using the name passed to the function, I name will neither give nor receive unauthorized help on this question. So I'm just going to copy that, and the students, when you guys took the exam, obviously you had the markdown file or the markdown in the notebook. So you could just have copied and pasted whatever you needed. So I'm going to use a formatted string or an F string. And fortunately, I already put name in curly brackets for you. So that's exactly what you are going to need. Hey, Dave, good to see you as well. So if agree is false, we're going to be doing something else. And what's that going to be? We're going to be printing I name do not agree to the required academic integrity statement and should fail this examination. So I think if we run the function like that, I've then got some test code, do not change or delete the cell. Obviously not really a good way to do unit testing. And then let's make sure it does what we would expect. So upstanding human beings got agree equals true. And indeed, upstanding human being is not going to give or receive unauthorized help on the exam. Chester McCheatface is going to get the default value of agree, which is false. So Chester McCheatface does not agree and should fail. Honest Abe is going to work even though the agree argument comes before name. And unethical deserves to fail. So it looks like the test code kind of worked more or less the way we would expect it. And then the second part of the question says to use your function in your own full name to confirm that you, in fact, agree not to give or receive unauthorized help. So I'm going to run integrity check, and I'm going to run it with my own name. And of course I agree. So I'm going to make sure that I can run this, and indeed I get the required integrity statement there. iLeakStein will neither give nor receive unauthorized help on this exercise. Okay, let's go down to part 3. So part 3 of the exam asks us to download data from Fred on the Wilshire U.S. Real Estate Investment Trust Total Market Index. And we've got it's not a ticker symbol, but we've got a Fred symbol on that, which is Will REIT Index. I could go to the Fred website and download this as a CSV and open the file. We saw how to do that in class. I could read that CSV file directly using a URL, but I'm going to do this using Pandas Data Reader, because we know that Pandas Data Reader is able to read data directly from Fred, which means that I'm definitely going to use Pandas, which I'll import as PD, and I'm going to import Pandas Data Reader as PDR. That's kind of my standard import. And this is the one package that we're going to use on the exam, which is not installed by default with Anaconda, but I had some instructions here about how to do an install, and already everybody in class should have had this thing installed from during the semester. Okay, so we're ready to go. We're going to download data from Fred on the Wilshire Will REIT Ind. And in order to do that, let's run pdr.datareader. So that's going to be a Pandas Data Reader package. What do we want to pull? Well, we're going to pull that WILLREITIND. Our data source is going to be Fred, which I think needs to be lowercase. And then I think if I don't put a start date in here by default, it's going to just get 20 years or something like that. But if I put in like a really old start date, it should work. No, it's got a complaint. No, that actually seems to have worked. So let's make sure that data looked the way that we would have expected. And what do we have? Well, indeed, we have data on the Wilshire REIT Index. The data starts, as I suggested in the question, in December 30th of 1977 and goes through, I think it was that yesterday, but it looks like there's a bunch of NAs. And the website for this Wilshire REIT Index describes it as daily data, but it looks like there are a bunch of missing values back in the day. So one thing that I might do just, as kind of a diagnostic is I might say, let's say resample this yearly, and I do have to spell resample correctly. And if I just look at the counts, I can see that I was only getting, well, I got one date's worth of data in December 1977, but then I was getting like 12 a year. If I plot those things, we can see it looks like basically I was getting kind of 1 or 12 data points per year. So I was only getting monthly data until sometime 1995, 1996. And then I started getting something approximating 250. That's probably weekdays or trading days worth of data per year. Okay, so I have an idea now. I should actually open the data up and see exactly what it looks like. And if I do that, I could check, but it turns out the data structure is in fact what I just suggested. And if you download the CSV, you could see that as well. So I would need to go do a little bit of research on what exactly the index is tracking. Does it include dividends or not? Is it commercial or residential real estate, et cetera? Although, like I said, I'm going to really focus on just the code today, not the interpretation. Okay, so provide useful descriptive statistics for the returns on the index. So, I should always read ahead in the questions. It turns out the next part of the question is going to ask me to calculate monthly returns. So one approach that I could take is I could say, hey, let's just start right now with working with monthly returns. And in order to do that, I could make a monthly data frame by taking my data frame DF and resampling it to be a monthly data frame, taking the last non-missing observation from each year and then calculating, for each month, and then calculating the percent changes. And if I do that, I am going to get a set of monthly returns, and those look like they're filled in for the full sample. I'm going to do some more analytics on them in the next question, but right here, I could do something like run a describe on those monthly returns. So, I've got the beginnings of a descriptive statistics, and I may want to make sure to interpret those better. On monthly returns, I've got 528 of those because those are going to go back to the beginning of the sample. Maybe what I want is instead to look at daily returns, in which case I could try to do something like calculate percent changes in the data. And the problem that I'm going to run into there, which I'll see if I look at the data, is that by default percent changes is actually going to calculate 0 returns for every one of those days that was missing data. So it's basically going to fill in all of the missing values before it calculates percent changes. And so if I were to do something like run a distribution plot on that thing, or run a simple describe on that, having already looked at the data, which of course is where I want to start, A, B, C, D, always be checking the data. I'm going to see, that those means look implausibly low. And I'm going to have a ton of zeros that have gotten filled in there. So fortunately for you, if you were taking this exam, I knew that this might be a problem. And so I said, hint, you should be careful about how you handle missing values. Maybe you want to drop NA. Maybe you want to use the fill method argument to the percent change, which you probably had to read the documentation on. Of course, if I drop the NAs before I calculate the percent changes, then I'm not going to have all those zeros that got filled in. The problem that I'm going to have is that a return, like for February 28th here, is going to be calculated relative to the previous non-missing data, which was a month earlier. So this data now analyzed like this would show that I had, say, a 2% return in February of 1978. But then once we have daily data, it's going to shift from calculating monthly returns to daily returns. And so that's a bug. It's an easy one to make. If you sort of looked at the data, you could see that the volatility just looks much higher in the earlier part of the sample. And if you dug in a little bit, you might realize that that's because these earlier periods are using monthly returns, and now we're getting daily returns. So, so how can we deal with this? Well, as suggested in the question, probably what we want to do is something like use percent changes, but we want to use that fill method argument. And whoops, if I run fill method equals, I'd have to go read that documentation. It turns out if I run fill method dot none, then it's just going to calculate NAs for any observations where it doesn't have consecutive observations. And so that's going to be enough then for us to do some descriptive statistics on the daily returns. Okay, so now let's move on. We're going to calculate monthly returns using the last value of the index for each calendar month. I already did that in that DFM data frame, that monthly returns data frame. And maybe at this point, what I should do is give that thing a more descriptive name in case I want to add something else. And so maybe I want to call it something like return, so that now rather than having the name of the index, we know that that's the return on the index monthly. I'm going to plot the distribution of monthly returns. My favorite way to do that is using Seaborn's displot. So I'm going to move back up to my import cell. I'm going to add an import Seaborn as S and S. So we're going to import Seaborn using our usual shortcut as S and S. And now I can run an sns.displot where our data comes from DFM, and on the x-axis, we're going to put that variable, which is now called returns, and that's going to give us a distribution of returns, which shows us we've had, one freak month where returns on the index were lower than a 30% drop, and one freak month where returns on the index were higher than a 30% increase. And we're going to learn about those months as well as some of the other extreme outliers. So when has the return been above 15%? Or below 15% in a month, and what was going on in those particular periods of time. So what that means is we're looking for the times where DFM's return column is greater than or equal to 0.15. If I just run it like that, we're going to get a Boolean series that shows false, except for the months where that thing is true. But maybe what I want to do is just find the observations in DFM for which that's true. And we can see that there are 2 months in which the return appears to have been positive and greater than 15%. Those are one sort of at the end of 2008, so kind of a housing crisis month, and then the other in April 2009, so a late housing crisis month. And we can do the same thing using a less than or equal to minus 15 and see that that the returns were extremely negative in October 1978, March 1980, October 1987, and then for a series of months around the housing crisis, as well as in what I would sort of consider a peak COVID month. Unfortunately, not necessarily peak COVID in terms of things like infections, but peak COVID in terms of market drops. And we've seen in class as well some, a slightly more efficient way of doing this, which I'll just type here because it actually would probably be my preference, would be to use the query method and just run a query and not have to type the thing twice. So we'll get exactly the same answer. So those are, what happened? How did I screw? Oh, that was less than or equal to positive 15. There we go. I wanted less than or equal to negative 15. Okay, let's talk about volatility. So now we're going to calculate realized volatilities. For each month, calculate the standard deviation of daily returns within the month. So that's going to involve there's different ways we could do it. That's probably going to involve a resample. So we're going to resample the monthly data down. I'm sorry, we're going to do a group by, and we're going to group by month. And then within the month, we're going to calculate the standard deviation of the daily returns. And we could do it with a group by, but actually I was right the first time I said it. And I think a resample is going to work better here. Okay, so here was our daily return data. This thing also has kind of a nasty name. So let's just call this one returns as well. Okay, and so now we've got daily data on returns. Of course, it's missing in the early part of the sample. And if we resample this thing at a monthly frequency, and how do we summarize them? We can take the standard deviation of returns for the days within the month, and that's going to give us for any month in which we have multiple daily return observations, we're going to get a standard deviation calculated there. So we could just try to analyze this thing directly. We could, run our analytics on these things. It has kind of this unfortunate name of RET because that was the thing that we aggregated up. But we already have a data frame of monthly data. So I think probably the best place to put it is actually there. And so we can just add a column to the monthly data frame called vol that contains that monthly resample with standard deviation calculations. And so now that monthly data frame has got both the returns and the volatility at a monthly frequency. So let's plot the realized volatility over time. We could maybe do a prettier one with Seaborn, but given that this is just a simple time series, let's do dfvol.plot. And we're going to get, because I want my monthly data frame. So we're going to get a time series plot of monthly volatility, and we can see it skyrocketing here. That looks like the housing crisis. And we can see it skyrocketing here. That looks like kind of early COVID. If you don't like all of the white space over here, which I don't really, we could just drop the NAs before we plot it, and we'll get a time series of just the non-missing values. So so there we go. So that's our plot of volatility over time. When has volatility or realized volatility been above 5%, and what was going on in those particular periods of time? So we're going to do this the same way that we did before. We could do a query, although we could also do this using a Boolean index. And let's look for when volatility was greater than 5%. And sort of in line with what we could have eyeballed off of the time series graph, it looks like that was during a series of months during the housing crisis, actually every month consecutively from September 2008 through May 2009. And then realized vol was high again in excess of 5% in March 2020, that big COVID month. Okay, using descriptive statistics, graphs, and or regressions as you see fit, how would you characterize the overall relationship between monthly returns and realized volatility in this market? So we've got the data frame we need in order to do that, which is a monthly data frame that had returns calculated end of month to end of month, and volatility calculated as the standard deviation of within month daily returns. Generally with this kind of thing, the place I would start might be, by looking at a Seaborn rel plot, where our data is going to come from the monthly data frame. On the x-axis, we could put the returns, and on the y-axis, we could put the vol. So that's going to give us a scatter plot, and just looking at the scatter plot, basically it looks like kind of when returns are highly negative, volatility is high. When average returns for the month or overall are very positive, volatility is high. That is sort of unsurprising if you think about sort of crazy times and calm times. It's also almost got to be true mechanically, given that the standard deviations are calculated off of the daily returns that aggregate up to form. So, looking at the graph, you might say, okay, it's sort of a U-shaped relationship, and we could characterize that in words as saying that, realized vol is high when returns are extremely high or extremely low. And that's going to be a nice description of what's going on with the outliers in this pattern. Of course, the bulk of the relationship is actually characterized by these months where average returns are in a much tighter range, say, plus or minus 10%. And so, one thing that might be interesting is just rather than running a relationship plot, to change that to an LM plot or a linear model. And Seaborn won't show us the coefficients, but it'll estimate the linear model. And the slope of the line shows us that the overall relationship appears to be negative. And we could run a regression. I'm not going to right now. We'll run some regressions later. But, I would sort of characterize this relationship statistically as being negative, although not necessarily statistically significant. But what does that mean from a finance perspective? Well, it says, that realized volatility tends to be lower when average returns are high and tends to be higher when average returns are low, which you could think of as, as sort of saying that that real estate prices as proxied by this index, follow a little bit of like a sawtooth pattern. They tend to go up relatively slowly and then down relatively quickly. So when they go up, like this. And then when they go down, they can fall with much higher volatility fast. Okay, so that is the end of question 3. I'm keeping an eye. Could we have done an OLS regression? Asks Dave. Yes, absolutely, we could do an OLS regression. I wasn't going to because I think the LM plot lets me make the point, but we're going to have to do some regression later. So let's try it. In order to do that, we're going to need to import, or we're going to need to have a way to do a linear regression. And the usual way that we've done that is using the stats models package. And let's import stats models formula API. Oops, stats models dot formula, STATSMODELS dot formula. Oh, forgot the as. Okay, so that is now imported. And am I going to remember the syntax without looking it up for running that regression? Let's see. So I think it's going to be something like smf.ols. And the model we're going to want to run, oh, good, it's given us a tip here. So this is going to follow Patsy syntax. What are we going to want? We're going to, if we want to replicate the result that the LM estimated, it's going to involve putting volatility on the left-hand side and returns on the right-hand side. That data is going to come from the monthly data frame, and I'm going to have to fit it, and then let's see the summary for it. And just the most naive univariate OLS regression shows that the slope of that return realized volatility relationship is like negative 0.04. Yeah, with these standard errors, which may or may not be the right one, highly statistically significant at conventional levels. So Let me know, Dave, if that got you set. Okay. Unless I'm coming back to it for a question in the chat, I am going to look at large Indian companies. So the question suggests looking at the Wikipedia page for the list of largest companies in India and downloading data on the largest companies in India according to the 2021 Forbes list, with some caveats about what that list is like. So I've already opened, whoops, that's one we're going to use later. Here's the Wikipedia page on list of largest companies in India. And here's that 2021 Forbes list. Okay, there it is. So let's get the URL. And fortunately for us, we've seen this in class as well. We can actually read HTML directly from a Wikipedia page. Let's do this, and we will we'll be able to do this, and actually without using any fancy additional packages like Beautiful Soup or anything like that, it should parse tables straight from Wikipedia. So let's call that Wiki page, and that's going to generate what kind of object? Well, it turns out what that is it's a list of data frames. And again, we saw this in class and on homework a number of times, where each of those data frames in the list is one of the tables on the Wikipedia page, and there were two of them. So the length of that thing is 2, and we could just see what happens if we get the 0th one, and it looks like, oh man, Reliance Industries Limited. Oh, indeed, look, that's the 2021 list that we were looking for. So that looks like the one we want. What's the first element in that list? It's kind of good to know that was the 2019 Fortune list. But we're going to work with the 2021 Forbes list. And so we could say DF India equals that thing. And now let's see what DF India looks like. Okay, looks like we got the data we wanted on the 50 largest firms. So here's the index, which starts with 0. That's added by pandas. And here's the rank, which came from the table. So let's just make sure that that thing looks good, and we're going to be able to do analytics on it. So the rank is an integer. That looks okay. The Forbes rank is an integer. That looks okay. The name is an object. The headquarters is an object. And then we've got some floats for revenue, assets, and value. But profit is an object. Man, what's going on there? Industry is an object. That's okay. This profit thing looks like a pain in the neck. I wouldn't really be able to do any descriptive statistics on that thing. And indeed, if I were to try to run, say, a describe on there, we're not going to get a number for profit. So what's going on? Well, let's look over at the table. These look like numbers. It looks like they should have. Oh, you know what? I bet I know what it is. I bet the problem is something like this Bharti Airtel, which has a negative number. And, you know, it looks to me like that's not a minus sign. That's like an N dash that's been entered in this Wikipedia code. What a pain in the neck. So I think we're going to have to do something about that. Let's try to deal with those. And I think the way we might want to do something about that would be, let's say, to take the, there's that symbol I didn't like. Let's take the DF India column called profit, billions of US dollars, and, you know, revenues were all positive, assets were all positive, value was all positive, but that profit column included some negative numbers, and that seems to have screwed some things up. So, and there's what we've got, and we've got some kind of negative signs that don't look good in there. I think I can do a string replace, and I'm just going to replace all of those nasty N dashes with regular minus signs. This is something that we saw in class for how to do with, say, like formatting dates. And I think that, you know, that thing is still an object. But if I were to, you know, I had to Google around a little bit and read the documentation. But I think that if I write something, run something like the PD or pandas. What's that function called? I think it's called as numeric. Let's see if that works for me. Is it as numeric? Sorry, I admit I do have another window open here. As numeric. Is that going to let me convert these things? No. Okay. So pandas, convert column to numeric. And, oh, it's to numeric, not as numeric. It always screws me up. Oh, look at that. So if we run the pd.toNumeric function on this thing, we're going to get a series that has a type of float 64. So now the negatives seem able to be converted. So let's just add that we could overwrite the old column. Let's just make a new column. We'll call it revenue. Equals the newly converted version. And now when we run info, we've got revenue here as a float 64. So we're able to get some basic summary statistics on all the quantitative variables there. We could do things like check some of the qualitative variables like, let's see, headquarters dot value counts. So we could think about, whoops, did I spell headquarters wrong? Oh, it's because it's called df_India. So, we could see that 25 of the firms are headquartered in Mumbai. We could make charts on some of these kinds of things if we wanted. We could do the same thing, say, for industry, if we thought that would be yes. Oh, thank you. So, Stephen notes that I was a doofus and I called this column revenue when it wasn't revenue. So I'm going to confuse myself that way because we do have a column called revenue. So let's call that profit and let's, I am rerunning the scrape, which is a little bit inefficient, but it's not a big thing to download. Thank you, Stephen. Nice job watching. So now I've got profit and okay, we've got, again, we can make graphs of some of these or something, but we've got things like descriptions for how many of the top 50 firms are headquartered in each of the regions or states, or cities, and what the breakdown of industries is. Okay, so now we've got some questions about firm size. According to the Forbes ranking, it's in the Forbes 2000 rank column. The biggest firm is the 55th in the world. So, of course, if the biggest firm is the 55th in the world, biggest in the world, and we see that here, that means that there are no Indian firms in the top 50 largest firms in the world. But then the question asks us, well, how many Indian firms are there in the top, 100, 250, et cetera, et cetera, et cetera. And so really all that's going to ask us to do is to try to figure out how many observations are there where the Forbes 2000 rank here is less than, say, 50. There are no such firms. Less than 100. There's one such firm. So there's one Indian firm in the top 100. How many are less than, say, 500? It looks like the top 9 are in the top 500. So basically what we're going to be doing is we're going to be, for each of these cutoffs, trying to calculate how many of the Indian firms have a Forbes 2000 rank, which is lower than that cutoff number. So I could just do this using, kind of a loop straight away, but I think I'm going to maybe write a little function to do it. So let's make a little function called like in top n, and we're going to take as an argument a data frame and an n. And what are we going to do? Well, given a data frame and an n, let's check how many observations. Maybe we should also get the name of the column to use, which I think is going to be called Forbes 2000 rank. Yes, Forbes 2000 rank. So let's get a data frame, let's get a number, and let's get a column name, which maybe by default we'll call Forbes 2000 rank. Okay, so what are we going to do? We're going to use the Forbes 2000 rank column, and we're going to find all of the observations for which the Forbes 2000 rank is less than or equal to n, where n is the cutoff. And so that's going to give us a Boolean series, which is true for firms in the top n and false for firms not in the top n. And then I want to know how many of those elements are true. So one way to do that, there's other ways to do that, is just to take the count, to take the sum of that, and all the trues are going to get treated as ones, all the falses are going to get treated as zeros, and so the sum of that is just going to be the number that are in the top n. So let's return that value from the function, and then we can sort of check and make sure that it works the way that we might expect by saying something like, well, if we use our df India, and we ask how many are in the top 50, there are 0 in the top 50. And if we ask how many are in the top 100, there's 1 in the top 100, which I think is what I expected, just Reliance Industries of India. And if I check the top 500, there's 9, which is what I got when I eyeballed it. Okay, so I again want to do more checking, but it looks like my function is kind of working more or less the way that I want it to, using that default column name. And now I could go to, well, here's the question. Here's the list from the question. Okay. And then I could do something like, say, for n in, and then let's go through this list. And we're going to go through the list 10, 250, 500, 1000, 1500, 2000. There's different things we could do with this, but let's do something like, let's print, and we'll use a formatted string, and we'll say, in the world's top n, there are, in top n, df India, n, firms in India. And let's see how that does. So in the world's top 100, there's 1 firm in India. In the world's top 250, there's 5. In the top 500, there's 9, etc. I don't know, maybe it'd be nice to also see something like what the fraction is, so we can run this count divided by n. It's going to be a little ugly, but this is 1%, 2%, 1.8%, 2.7%, 2.4%, 2.5%. Okay, so that's the fraction and the number above each threshold. And then the next question we get here is, are there any particular parts of the world's size ranking within the top 2000 where Indian firms appear particularly well represented? So basically what that's asking is there any place where there's a lot of these ranks that are kind of close together, right? Like it's saying, like, is there a cluster within this Forbes 2000 ranking where there's a lot of Indian firms that are kind of clustered together? So one way that I might sort of start to get an idea would be to just see, like, what is the distribution of those Forbes 2000 ranks look like. So maybe I'll make a rel plot where on the x-axis I'll put the Indian ranking, which is rank, and then on the y-axis I'll put that Forbes 2000 rank, which is the global ranking. And if I do that, basically this is showing like these are evenly spaced, right? We go from 1 to 50, the top firms in India. And then this is showing where the nth firm in India ranks in the Forbes Global 2000. And so basically anywhere that this thing is kind of steep, there's relatively more Indian firms. And anywhere that this thing is, anywhere that this is steep, there are relatively fewer Indian firms because you have to go up a lot of Forbes 2000 ranking spots as you move down the Indian ranks. Whereas like here, you can kind of see this flat part is saying that there's a whole lot of Indian firms. Looks like it's about firm 18 or so through firm about 23, all of whom seem to be pretty close together in the Forbes 2000 global ranking. So it sounded like that was about firm 18 through 23. And then we could just go eyeball it and say, oh, wow, look, that's 1, 2, 3, 4, 5, 6 firms, all of whom lie within, oh, look at that. That's actually, there's 7 firms. There's 7 firms that all lie within rank 770 through 833. So, there's kind of a high density of Indian firms in that part of the world, firm size distribution. That's a place where, there's a range of 100 ranking spots where more than 6% of the firms are in India. So that's like that's one way to do it. If we wanted to sort of do a less eyeball-y way to do it, one way to do it might be like this. So, I've got the DF India, ranks in the global ranking, right? So here's sort of the, here's the column of, that shows, the rankings in the Indian, in the global ranking. And then what the question asks is like, is there anywhere where there's a lot of firms, that are all within 100 ranking spots of each other? So, one thing that I could do is I could basically ask like, how different are you from the place 6 elements above you in the list? And that's what the diff pandas function does. This is one that's been described in a bunch of the texts, although we haven't used it in class. You could also do this using a shift and subtract. And so what this says is like, obviously for the first 5 Indian firms, you can't look at the Indian firm, which is 5 spots bigger or 6 spots bigger than it. But this says, if you take the 6th biggest Indian firm, it is 311 global spots bigger than the firm which is 6 Indian firms smaller than it. That's the top 0 firm. So if, for example, we take that 6th firm in the list, note this list starts with 0. So if you take this Larsen and Tobro in Mumbai, they're ranked 366, and that puts them 311 spots behind the firm, which is 5 ahead of them in the Indian rankings. And so if we basically take that and we basically say, okay, where is that thing less than or equal to 100, that's going to tell us where are their firms. There are more than 6 of them, or 6 or more of them within 100 spots of each other. And it's firms kind of 19 through 22. And so, we could use that as a filter on the Indian data frame. And what did I do? I just have a typo. And we'll get, here are the firms in the part of the firm size distribution where things are kind of clustered together. So that was a little bit of a tricky one. Okay. Financial ratios. So let's calculate the total asset turnover, which is revenue per dollar of assets, and the revenue multiple for each firm. Okay, so I can't remember my column names. I probably should have cleaned them up a little bit, but here they are. And I guess I'm going to make 2 columns, and I'm going to call them, both of them are going to be, let's see, why am I having trouble doing that column selection? There we go. Okay, and they're both going to involve dividing DF India something by DF India something. Okay, so what are we going to make? We're going to make one called total asset turnover. We're going to make one called revenue multiple, let's call it Rev M for revenue multiple. The first one is going to be revenue per dollar of assets. And the next one is going to be value divided by revenue. And hey, guess what? We didn't actually need that profit number turned into a number to do these calculations, but we got it. Okay, so how did those work? Well, now we've got calculations of total asset turnover and revenue multipliers for each firm. We're asked to calculate the distribution of total asset turnovers across the 50 firms, and there seems to be one outlier. What is it? So let's start out by plotting the distribution, which, as before, my favorite way to do is using a displot from Seaborn. And so on the x-axis, we'll put total asset turnover. And lo and behold, whoa, there's one way out there. So what is it? Let's take this total asset turnover column and let's sort. Sorry, actually, let's take the whole data frame and let's sort values by gosh, I'm having a little trouble with my keyboard. Okay, so that's going to give us the firms sorted, looks like lowest to highest. Yeah, that's the default with sort values. So let's do ascending equals false in order to get the highest total asset turnover firm. There it is. Okay, there's the 7.95. And so we can get the first element there by doing lock 1. Oops, by doing ilock 1. Dangerous. Nope, by doing lock 1. No, what did I do? Well, I'm going to be lazy. Oh, I know. Stupid me. It's because it is ilock 0 because Python is 0 indexed, but I'm checking the data and I was looking for that total asset turnover 7.95. So it's Rajesh exports in gems and jewelry. Huh, interesting. Okay. So our one outlier on total asset turnover is a gems and jewelry firm called Rajesh Exports. Why might they have such a high total asset turnover? Well, I wonder how they compare with the other gems and jewelry firms. Oh, wait, we already did this and saw there's only one gems and jewelry firms. And if you look at the rest of this industry breakdown, my guess is they're very high total asset turnover because they are able to keep low inventory and they sell a very high value commodity like product that they're able to turn over very quickly from a revenue perspective. Okay, what is next? Let's do the same thing for the revenue multiple across the 50 firms. And where is the high total asset turnover outlier you identified in the last question in this distribution? So we can do the same thing, just now we're going to plot the revenue multipliers distribution, and we can see where they look. And then we've already got this printed out. So gems and jewelry firm Rajesh Exports has a revenue multiplier of 0.06. And you can see that puts them, very low. 0.06 puts them extremely low. And if you think about what these multipliers are, I mean, I'm not an accountant and it's not an accounting class. But as Alex notes, yeah, these are luxury industry firms. So it makes sense that if you've got a high total asset turnover, you're likely to have a low revenue multiplier, all else equal, because revenue is in the denominator of the total asset. Let me say it right. Revenue is in the numerator of total asset turnover, and it's in the denominator of the revenue multiplier. So all else equal, if you've got very high revenue relative to other elements of your business, you're going to be high on TATO and low on the revenue multiplier. Okay, there are 4 industries with more than 3 firms on the list, which seems to have a strong relationship between assets and revenue. Okay, so let's start by figuring out, we had it before, but let's get them again, and let's get the DF India industry. Okay, so there was our DF India industry dot value counts. And we can see that the four industries are banking, financials, infotech, oil and gas. So, we could work with that list manually. If we get the index from this, that actually is going to give us just the names of these in order. And so if we pull off the 0 through 3rd elements, that's going to give us, the 0 through 4th elements, because it's exclusive of the end of the index. We've got banking, financials, infotech, oil, and gas. And so we could just make a list of those to have it on hand. And okay, so that's going to give us a list of the industries we're interested in. Okay, so the question asks us basically, for those four industries, are there any that seem to have a strong relationship between assets and revenue, and any which have a weaker relationship between assets and revenue? So one way that we could think about that is, the relationship between assets and revenue is just calculated by, or is what total asset turnover is. So, one way to do this would be to just say, let's get all of the elements of DF India for which DF industry is in that multi industries list. Okay, so that's going to give us a Boolean series based on whether the firms are in those four industries. And so if we use that Boolean series as an index into DF India, that's just going to give us the firms that are in the four industries that we're interested in. And we might do something like ask, well, what's the distribution of total asset turnovers? Oops. What's the distribution of total asset turnovers by industry for those four industries? Okay, and that did not work. Why? Because in the later versions of Seaborn, you've got to tell it the data is the data. So, so what we're looking at here is we're just looking at a cat plot, a categorical scatter histogram. Again, this is a chart type we've used tons and tons in class, of total asset turnovers by across the firms within the industries for which we have more than four or more firms. And you can see there's sort of tight clustering for banking, somewhat wider clustering for financials, much wider or somewhat wider clustering for infotech, and then even wider clustering for oil and gas. So one way to sort of see what's going on is to just use the distribution of total asset turnovers and say it looks like revenue and total assets is closely linked in banking and financials. Maybe makes sense to the degree that the assets in these industries are sort of relatively homogeneous and they're highly competitive. Infotech and oil and gas are much more, they're much more dispersed in terms of business models. Oil and gas firms in particular, some of them may have a ton of proven reserves that they're not yet extracting from. Or another way to see this is rather than using total asset turnover, is just to say, let's actually go directly to the underlying variables of interest. And so let's look at a relationship plot for those same industries between, maybe we'll put revenue on the y-axis and assets on the x-axis. Okay, so this is a scatter plot where we have one dot per firm for each of the firms in these industries. And so the slope of the line going from the origin to a given dot is telling us their total asset turnover. We can't see anything about industries there yet. Whoops. But if we break out the industries, we can try to see if the relationship is stronger in some versus others. So one way to do that, And again, these are things that we did in class in other contexts, is to do this with a color breakdown, a hue breakdown. And you can see there's big banks and there's small blanks, but all the blue banks are kind of clustered on the same diagonal. Whereas for oil and gas firms, you've got oil and gas firms that have, assets of, revenue of 8 billion. And then you have oil and gas firms with, roughly similar assets, but revenue triple or 5 times as high. So, that sort of helps me. If you don't like hue, we've also seen that you could do this by faceting across columns. There's lots of ways to do this. And so, here we get each one on a separate graph. You could run these as linear models instead, if you preferred. Okay, so it looks like the relationship is strong in banking and less so in financials, weak in infotech and oil and gas. And in line with David's question, I'm going to bring it back up, even though it was from a different question, where I sort of showed a graph, and Dave said, could we have done an OLS regression? The answer is yes. Again, here we could do an OLS regression. Okay, I got my large Indian firms. Now let's look at Turkish insurance companies. So we are going back to Wikipedia. Where are we going on Wikipedia? We're going to go to the list of companies on the Istanbul Stock Exchange. Oh man, I have not spent much time thinking about companies listed on the Istanbul Stock Exchange, although Ulash has and said that he was going to try to work on this problem. So here's the Wikipedia page, list of companies listed on the Istanbul Stock Exchange. We've got company names, we've got symbols, and then we've got notes. And what we're asked to do is to find the tickers of the 6 insurance companies whose names start between A and L. Why between A and L? Well, it's because actually whoever was filling in this Wikipedia page, and I bet it was someone who was maybe translating from another source, hasn't bothered yet to translate and fill in for the firms later than M. So if you're a Turkish speaker and looking to edit Wikipedia, here's a place that you could go, is add company descriptions for Turkish firms listed in Istanbul starting with letters after M. Okay, so again, we are going to get the URL of the page, and we're going to get a, let's save it like this. Let's do wiki page equals pd.read.html URL. And I wonder if wiki page element 0 is, I'm going to do df.is for Istanbul Stock Exchange. And that did not work. So what did I do wrong? Oh, I put URL in quotes. URL is not the URL. The URL is in a variable. So how did that work? It worked. Ooh, okay. Not very well, because what I got appears to have been this economy of Turkey thing from over here. Okay, so let's do this right. Let's get the length of wiki page. It's got 3 things. We know it's not thing 0, but it looks like it's item 1. Okay, so let's pull off item 1 and call it data frame Istanbul, and there it is. What are our columns? The first column is an index that's added with just row numbers. The next column is the company name, although it's got some weird stuff like A and presumably other alphabetical headers, a symbol, and a note on each firm. Okay, so we've got 386 rows in there, but not all of them are firms. Okay, so what do we want to do? I'm going to save this. We want to find the tickers of the 6 listed insurance companies. How can you do this? Well, one way to do it, I suggested, is to look probably in that notes column for the word insurance. Okay, so if I do df Istanbul and I get the notes column, that'll give me just all the notes. And I even told you in the question that the function you might want to use is the str lower to convert to lowercase and str.contains to find strings containing the word insurance. So you could go read the documentation on that. If we do contains insurance, all in lowercase, we've got 3. And if we do contains insurance with a capital I, 3 plus 4, that would be 7. Well, let's see. What if, though, we make them lowercase, and then we check for containing the word insurance, and we've got 6. So it looks like there is probably one of them that mentioned both capital insurance and lowercase insurance in the same notes column. So there is going to be a Boolean showing just our insurance companies. I'm going to filter this and call it df underscore insurance. And I'm going to make that just the ones for whom that thing is true. And what did I do wrong? Did something wrong. Undo, because it looked like it was working. Okay, so there were and then I wanted the ones for which that was true. Huh. What did I do wrong? Why did that not work? Oh, I see why. I think it's because I've got some NAs in here. Why do I have any NAs? Well, I think maybe it's because, let's see, it's like item 381. So let's check. Okay, and it looks like, if the notes were missing, then that lowercase function, instead, it was like, I don't know what to do. So we got to get rid of those NAs in order to make a Boolean series that we can use. And we can do that using fill NA, and I'm going to fill all the NAs in with false. So anywhere that it couldn't even run lowercasing, it's just going to, it will have given an NA, but let's fill those in with false. And now if I filter the Istanbul data frame with that, I've got our 6 companies, Aksigorta, etc., down through Halksigorta. I apologize for my pronunciation there. Okay, so let's make a data frame with our insurance companies, and there they are. Okay, so let's go try to get some data on these firms. So the next thing that I'm asked to do is you should be able to pull data on 4 of these stocks from Yahoo Finance. For the 4 companies you can get data on, let's pull data 2005 through 2020. Well, let's just take one of them, I don't know, AKGRT, and let's actually go over to Yahoo Finance and just see, because, it asked me to find data on, I see, okay, so here's the firm, and it's got data on the Istanbul Stock Exchange, but the ticker that's listed on Yahoo Finance is AKGRT.is. So presumably that .is is because it trades in Istanbul, and indeed we've seen in class that foreign stocks are often going to have like a dot formatted ticker with a country code, at least on Yahoo Finance, and that we can put those things into the Yahoo Finance API. So here I've got my... Okay, so there I've got the symbols that I need, and if I did something like want to add a .is to the end of them, we've talked about how to do that in class a number of different ways, but my favorite is probably just to use list comprehension. If we had a million of these, this would be an inefficient way of doing it, but is to just use string addition and iterate over these. And that is not going to work. Why? Because I need to, I'm not going to be able to iterate over these things. I'd have to iterate over the values, but a lazy way of doing it is, okay. It's not list, is it? It is... let's just see. Is it values? There we go. So let's try. Shoot. Oh, it's because I put a T. Silly me. It's a T for ticker, not an I for the number. It might have worked the other way before too. Okay, so that's giving me a list of all the tickers that I want. And we know how to pull data from Yahoo Finance. So this is going to be, let's say, Yahoo Finance insurance. And it's going to be using a PDR dot data reader. We've done one of these already today. There's the tickers we want. Our data source is going to be Yahoo. Our start is going to be, when did I ask you to start? I said 2005 through 2020. Start equals 2005 and equals 2020. And how's that? Ooh. Oh, look, 2 of them didn't work. Well, 2 of them didn't work is fine, because 2 of them didn't work means I got 4, and that's how many I told you we were going to be able to find. Okay, so we've got data on 4, 1, 2, 3, 4, and then we've got missing values for the other 2. So let's try to work with that. So what do we want to do with them? Well, we are asked to calculate the average daily return for each firm. So let's take this data. Let's get the adjusted close columns, and let's calculate the percent changes. So those should give us daily returns, and let's describe them. Okay, so that should give us, we've got 0 observations for these 2 firms, but for the other 4, we've got a mean daily return for each of the 4 of them, all of which are positive. Let's see. Let's plot the adjusted closes over the 16-year period. I guess I actually skipped that one. I certainly hope that those graphs go up, because the mean returns look like they are positive, which of course is not exactly the same. But if I just plot those adjusted closes, we do get that all 4 of these lines seem to be going up over time. If I was less lazy, I could drop the columns that are entirely missing, but I feel a little lazy, so I'm not going to. No, you know what? We'll leave them in there. Why not? Okay. Next up. So we've got adjusted closes plotted. What's the average daily return for each firm we got? Calculate the correlation of daily returns across the 4 firms. So we've already got our returns here, which was this thing before we ran the describe. So there were our daily return time series. And if we just run correlation, we'll get a correlation matrix across the columns. So of course, each thing has a correlation of 1 with itself. ANSGR and AKGRT have a correlation of 0.45. ANHYT and AKGRT have a correlation of 0.43, or daily returns correlation of 0.43, and ANSGR and ANHYT have a daily returns correlation of 0.49. So we've got 4 firms on which we have data. 3 of them start with the letter A, and they all have correlations of daily returns between 0.43 and 0.49. And then the 4th firm, HALKS, has correlations of 0.22, 0.22, and 0.22 and 0.21 with the other 3 firms. So it looks like we've got kind of one relatively clustered set of 3 firms that all start with A, and then one which has a much lower correlation that starts with H. Okay, there's one calendar month during which every one of the 4 firms had returns above 15 basis points per day. which month was it? So again, this is something, we did something similar in class where we did this asking questions like what's the seasonality of mortgage interest rates by taking a data frame. There it was weekly, I think, and aggregating up to monthly averages. And so here we want to do monthly averages as well. And what is it that we want to use in order to do that? Well, we want to do a group by. And what do we want to group by? Well, we want to group by the, we want to group by the calendar month of the index of this thing. Okay. And so that's going to aggregate up and group by the calendar month, so January through December without the year. And then how do we want to calculate our within group means or our within group aggregates? We're going to take a mean. And so what that gives us is a data frame. So this is like the mean daily return for January for AKGRT, the mean daily return for February for AKGRT, the mean daily return for January for ANSGR, et cetera. We could just plot this thing and sort of stare at it. And, if I sort of with my mouse draw where the 0.15 line is, it looks like maybe July. No, it looks like it's going to be December. It does look like it's going to be December, but we can also check that by looking at the data frame and eyeballing it. So here was the data frame we just looked at a moment ago before I plotted it, and we could kind of look across, and indeed all of these are above 15 basis points per day for December. Another thing that we could do is we could actually check where these things are greater than, that would be 15% per day, but where are these things greater than 15 basis points? And now you can see that it's in December. And if I really wanted to go the extra step, I could take these things and I could ask to summarize them using all along axis 1, which is the row axis. And what did I do? I see what I did. Shoot, now I'm having a problem with these two columns where they are all false. So I'm going to not, I could get rid of them. I could have gotten rid of them earlier, but I'm a little lazy and I'm not going to. So it is December. Is anybody watching? How you holding up? I'm going to just look and see if anybody's watching. It's fine if nobody is, but I haven't seen anybody in the chat for a little while. And so then I get nervous if, I'm still going to do it. Hey, Rando, MBA Head, and Drew. I think everybody else I've managed to drive away. Okay. Yes, Brendan. Hi, Brendan. Good to see you here. Thanks. Okay. So, this is like optional and we're going a long time already. And, I know it's going to be on video, but okay. We got the last one, CAPM betas during COVID. So, we've pulled data before on daily returns. Yeah, Najid, good to see you as well. We've seen, daily returns, on all of the S&P 500 firms. And, Brendan says, is it supposed to stop at 2020? So I put in a stop of 2020 up here when I pulled the data. I think hopefully that gets it. Brendan, but let me know if I missed something. Okay. So, I didn't want people hitting APIs quite so hard. So we pulled this data before. It was on the course webpage, which is publicly available for anybody who wants to check it out, with a syllabus and other stuff. And under data files, oh, you know what? I actually don't think I didn't include the URL there for a reason, but I did put the URL in the exam. So, so here's the URL that we're going to be looking to get this data from in a CSV. You don't have to be sorry, Brendan. We're in good shape. Okay, so there's the URL that we're going to want to get as a CSV file. And then look at this. I even told you exactly what code you might want to use in order to get this slightly nasty CSV that has 2 rows of column headers in it. So let's just use the code that was there. Okay. So that thing, what? Oh, I see. Why is this not coming down? Did I not, I imported pandas. Why am I not able to, what am I doing wrong? Oh, I see why. If I had actually downloaded the file, it would try to read this SP500, spyahoofinance.csv from a local path. Hey, Dave, glad to see you here as well still. So I could download the page using my web browser. I actually already have it, but let's just get it directly from the URL. And this is not a tiny file, so this is not great practice to download it that way, but there it is. Okay, and so what do we have? Well, we've got 467 rows. We've got 3,030 columns. And what are the columns? Well, it's standard Yahoo Finance API columns. Okay, so we've worked with data frames that look like this a lot in the past. First question, generate a data frame of daily returns using, oh man, I'm so nice. Look, I gave you the code right here. So let's just do it. Okay, there's literally nothing to do here that's not exactly what was in the assignment. Okay, so now what do we have? We've got column names are symbols. And column names are symbols, and there's 505 of them. And the index is a date. Okay, so part one, generate a data frame of daily returns using the adjusted close percentage change. Boom. You can then generate a list of tickers using, take the column names and make a list of them. Oh man, I'm a nice guy having told you how to do that. Well, we already saw that that thing had 505 elements to it. We could say like this, and then we could check out this list, and there are 505 of them. Why are there 505? Well, because there are 500 firms in the S&P 500, but several of them have multiple share classes and trade under more than one ticker that's included in the S&P 500, and that's something that we've talked about at some length in class and encountered in our data before. Okay, calculate the equal weighted average daily return across all the tickers. Okay, how do I suggest doing that? Well, I suggest doing that using exactly this code, which I'll just show you again. Okay, so here's DF returns. Each column is a different ticker. Okay, and so then what I'm doing here is I'm taking the average across axis 1, which means the horizontal axis, so across every column, and we're going to calculate a new column called DF returns market. Okay, and so we could make sure that thing. Okay, so what's that? That's a time series plot of the daily return. So, I can't see like our returns on average positive or not. What I can see from this plot though, is that it looks like there was heightened volatility. And what was this? Well, that's like March 2020. So that's kind of that peak COVID time where we've got a lot of big positives and big negatives. And then, the average magnitude of returns has been declining, quite a bit, since then. Okay. So at least they look, more or less like what I would expect. And again, if I were really doing the final, I'd want to check more of this stuff. Okay. Using weeks running Thursday to Wednesday, which week had the highest average daily market return and which week had the lowest average daily market return? So that means I'm going to want to take this column, DF returns market, and I am going to try to calculate within week average daily returns on that thing, which means I want to resample it, and I want to resample it weekly, and I want to take the means of each of these things. And of course, the problem that I'm going to face is that by default, these weeks, I could even check, run weekly with weeks ending on Sundays. And that's not what I want, because the question asked me to use weeks running Thursday to Wednesday. And so I might have to go check the documentation, or I may remember, because we saw how to do time series resampling for quarters that didn't end, fiscal quarters that didn't end on a December year end, et cetera. And so if I do a Wednesday end weekly resampling, I get these things. And, I'm a little bit superstitious, so I just like to double check. This does say weekly Wednesday, but I might do something like go check what was going on November 10th, 2011. Whoops. Okay, I could go pull a calendar up, and what are you going to tell me? It was a Thursday, November 10th, not 2011, 2021. Do I trust this site? I don't know. Pretty janky looking, but it was a Wednesday. Okay. I seem to have, in fact, gotten Thursday to Wednesday weeks. And if I do assort values on this thing, okay, I'll just be able to read off that the highest return was in the week ending on Wednesday, April 8th, 2020. And the most negative, or the highest average daily returns were in the week ending Wednesday, April 8th, with an average daily return of positive 2.74%. And the lowest average daily returns were in the weeks ending March 18th, 2020, with average daily returns of negative 3.5%. Okay, so that was the question. And then, okay, I'll show you the question. The next question was, are there any Thursday to Wednesday weeks in the sample with only 1 to 3 trading days in them? What about Monday to Friday weeks? So we can take the same code, except now rather than aggregating by means, we could aggregate by counts. And okay, what we'll see is that we had 1 week with 0 observations, but that's, I could go look. It was because it was at the beginning of the sample. So we had 1 day, but we didn't have a return because we didn't have a previous price to calculate a return from. We had 1 week, which was the week ending November 10th, 2021. Well, what's that? That was the week at the very end of the sample. So it wasn't that there was only 1 trading day. It's just that we only had 1 return before the sample ended. And so otherwise we could dig in on those and sort of rule out the possibility that there were weeks where the markets were closed for 3 days between a Thursday and the following Wednesday. But if we use a Sunday ending week, or sort of a traditional calendar week, this week, which was the week ending on the 5th of January, only had 2 days. But again, that's because we had the beginning of the sample there and not enough data. Okay, so we are, I think, done with this part of the question. And now we can go to the next. Beta calculation and analysis, the very last part of the exam. Okay, set up an empty data frame with 1 row for each ticker using this nice thing that I suggested that you do. So let's set it up. And I should note, this is not actually probably the best way to do this, but this is the way I suggested because it uses the tools we know in class. So here's what we do. We're creating, and I'm just using the code that I gave you, which is to create an empty data frame. So it's filled entirely with missing values. And what do we put in there? Well, we made a column called beta 2020, and we made a column called beta 2021. And those things are set up to be floating point values. And what's the index? Well, the index is that list of tickers, 505 of them that we identified and set up in the last part of the problem. So the main task, which is a bit challenging, is to populate this data frame with firm level estimates of CAPM beta separately for the years 2020 and 2021 using our daily return in data and our market index MKT. Okay, so What are our problems? Well, one problem is that, we may have a ticker symbol that's got some kind of non-letter-like symbols in it. And another problem could be that maybe not every company in the S&P 500 existed in both years. But let's start to try to calculate this thing, and then let's see where we go. So what I'm going to do is, and again, this is like something we did in particular the day before Thanksgiving. We did this in class, or something very, very close to this in class, and that code was distributed. So what I'm going to do is I'm going to set up the model that I want to estimate, and I don't know, I'm going to do this in more steps than perhaps necessary. What do I want to do? I want to regress the ticker on the market index. And what do I want? Well, I don't want the word ticker. I want that variable ticker. So I guess what I want is I want the string, or ticker's already a string. I guess I want the ticker, and then I want to add a string, okay, like this. Okay, so I could just make sure that this is working. Okay, and let's just try, let's say the first 10, just to make sure. So these are strings that describe the models that I'm going to estimate. And so maybe I'll just give myself a little bit of news about how things are going. And I'm saying print estimating okay, so this is just as it cycles through, it's going to tell me which model is getting estimated. Okay, what do I want to do now? Well, I want to set up my data frame, and therefore set up my model. So what's the model going to look like? Well, the model is going to look like smf.ols. We're going to estimate it using the model string. And what's the data going to be? Well, first I'm going to want to estimate it using, what's this data frame called? Well, all of my returns data was in a data frame called df returns. So there's the data that I want to use, but I want to make sure that I am just using the observations where the year is 2020 or 2021. So one way that I could do that is just by saying I actually want to get the 2020 observations. Using a .lock is probably a little bit more robust way of doing this, but this is a common way that we've done this thing in class. Okay, so that gets us set up with a model to estimate and data to estimate it with. Let's fit the model, and then let's get the parameters. And what element do I want off of the parameters? Parameters, it was a list, and I wanted to get the coefficient on market. Okay, so let's just kind of make sure that this seems to be working okay. Okay, so looks like we're able to estimate betas. Again, I'd probably want to do a little bit of indexing a data frame with a date time like index using a single string to slice the rows is deprecated. And oh yeah, I should use lock, shouldn't I? I'll do what it suggests, because it really is a better way to do it. And then hopefully I'm not going to get that warning anymore. Okay, so looks like we're in good shape. And what do we need to do? We just need to store this thing. And where am I going to store it? I'm going to store it in my firm's data frame, this one that I made. And where in there am I going to store it? I'm going to store it at the location for 2020 and the ticker. Okay, so if I run this thing, and oh man, I got a lot of printouts, but let's see now what's in my DF firm's data frame. Is it working the way I would expect? No, doesn't look like I got them. What did I do wrong? Oh, I didn't want 2020 comma ticker. I want, oh, look, yeah, I can see I got a whole bunch of junk in there. I want ticker is my index. And then I want, it was called beta 2020. Okay, so let me reinitialize this data frame. And then let me try to start populating with betas. And then let's see. Ooh, well, that didn't seem to work either. Why did that not? Oh, I see why. Because what I put in there was the return from printing this thing out. And I didn't mean to print it out. I actually wanted the value itself. Okay, and what now do I have? Yeah, look, I got some betas for 2020. Nice. Okay, so that looked like it worked okay. And now all I should need to do is also do the same thing for 2021, but filter on 2021. And again, I only ran 10 firms, but they seem to be working out okay. Nice. Okay. So let's try to do this on the whole list of tickers, and they're getting printed out one by, oh, shoot, I got a problem. Oh, look, it's BRK-B, and that's a ticker that we know well from in class. We've spent a lot of time looking at BRK-B, which is Berkshire Hathaway Class B. And what's the problem? Well, I actually warned you, stats models may have a problem with tickers including non-letter-like symbols. Now, somebody did ask me about 2 weeks ago on the course Discord what to do about this, and I answered, I have no idea, but I looked into it, and I did, tell you, oh man, this is exactly the thing that may be tricky. It turns out that when you set up the model string, if you have a variable name that has non-letter-like symbols in it, what you want to do in stats models is you want to put it in Q. Whoops. What did I do? Estimating QMMM on market. Oh, shoot. No, it's Q. And then in a single quote. I mean, again, this is why you just got to go read and find the documentation. It wasn't easy, but we did deal with this problem. And there we go. Okay, so we got through. Looks like they're running. Oh, now we have a problem after who? We have a problem after OGN. No, we have a problem estimating OGN. So what could be going on? Let's look at DFO returns, and let's look at the OGN. Oh, look at that. Ooh, it's got a lot of missings up front. Guess what? Turns out we don't have any data on OGN. We could see this, for example, by looking at the counts, and we don't get any. We get 10 observations starting in May 2021. Is that an IPO or a ticker change? So what do we want to do? Well, there's different ways that we could handle this. One thing that we could do is we could try to just somehow kind of catch the error somehow. My kind of preferred way to do it would probably, we could just drop OGN and see if we get a problem somewhere else. My preferred way to do it, I think, is to do it like this. And it's to say, okay, well, let's get, here's the data that we're going to need to estimate this thing on is going to be the DF returns for 2020. And in the ticker column, we can actually just show you how this would work. Okay, so like OGN. Okay, and then we could run a count on those, and we've got 0 observations. Okay, if we run it for 2021, we've got 121 observations. So I'm going to say something like, if this thing dot count is greater than min observations, and we'll just set up, I don't know, maybe how many observations do we think we need? Maybe 100 observations. to be willing to run an estimate. So let's only run, again, not the very best way to code this, but the best that I'm going to do right now. Okay, so if we've got more than 100 observations for 2020, we'll run that estimate. If we've got more than 100 observations for 2021, we'll run that estimate. Okay, looks like we're making it through. Oh, nice. ABC, always be checking the data. It looks like we got them. And so now we can look, what do we get asked to do with these betas? We've got a data frame of betas. What was the average beta for 2020? What was the average beta for 2021? And regress and or use this scatter plot command. So let's, we've got these DF firms. We've got the beta 2020s. In one column, we've got the beta 2021s in another column. So we can just describe this. We've got a mean beta of 0.999 for 2020. We've got a mean beta of 0.999 for 2021. Or actually that's 0.9994 and 1.0000. We should expect and hope that those things are basically 1 because we calculated betas with respect to an index that was the equal weighted average of exactly these firms. So, modulo some panel balance issues, we should expect to get average betas of 1. And if we look at this scatter plot exactly as suggested, it looks like what we've got is a fit that is like, I don't know, really, really nice. What did I say? I think I actually said to run the regression, didn't I? Regress the 2021 betas on the 2020 betas. Okay, so let's run that smf.ols. Our model is going to be beta 2021 on beta 2020s. We're going to do this using DF firms, and we're going to fit it. And let's see the summary. Okay, and what do we get? Well, we get an intercept, which is slightly negative and significant, and we get a beta, a slope on the beta, which is positive and appears to be significantly greater than 1. Okay, and so what that says to me is we know the mean of this distribution stayed the same. It more or less had to. Okay, but in fact, you can see the standard deviation of the betas goes up from 0.36. That's a cross-sectional standard deviation, equal weighted of betas across the same set of firms for 2020 and 2021. More or less the same set of firms, except that one, perhaps that IPO'd. So the cross-sectional dispersion of CAPM betas has gone up from 2020 to 2021, and that's consistent with the idea that there is, a positive coefficient on the 2020 beta in explaining the 2021 beta. So basically, the firms that had high systematic risk tend to have even higher systematic risk, and the firms in 2021, and the firms that had low systematic risk seem to have even lower systematic risk in 2021 than 2020. That is a final exam. I can't believe how long I've gone. It was a pleasure having you. I am going to post this video for anyone and everyone interested.